So last week, the Fed dropped the rate a quarter percent. And at that time, the average 30-year fixed mortgage was at around 6.8%. And over the next week, mortgage rates actually got worse by about a quarter percent. There's a lot of confusion as to why this would happen or how do mortgage rates go up after the Fed lowered the rate. Right off the bat, I'll tell you, it's not a bank conspiracy. The banks aren't increased their profits. There's simply too many mortgage companies for that to happen. There's over 1,000 mortgage companies in the U.S. One mortgage company wanted to increase their margins and profitability. They would just lose all their business to another competitor that's willing to operate at a constant profit margin. Remember, mortgage rates move off of certain bonds in the bond market. So the Fed dropping the rate a quarter percent was already priced in several weeks earlier into the markets. The markets also expected the Fed to take a neutral tone on what they would do in the future regarding lowering rates, and they expected to hear that they'll continue to do so. But that didn't happen. In a nutshell, Fed Chair Powell indicated that inflation was going to be sticky, that it wasn't really going to go down much, that unemployment was going to be lower than expected, that overall the U.S. economy was going to be stronger than previously thought. But basically that they're going to be very cautious in continuing to lower the rates. And that's what sent the markets, bonds, into a sell-off, which is why mortgage rates went up. If you want to accurately track mortgage rates, follow the 10-year U.S. Treasury, which is currently at around 4.6%. Add 2.5% to that, and that's about where the average 30-year fixed is, around 7.1%. So be careful what you read out there. There's a lot of misinformation, but if you ever have any questions, feel free to message me, and I'd be happy to answer them.